Investment Management. He joins us now. Brian, thanks a lot for joining us. You are watching for results and guidance from the likes of Walmart, Home Depot, Costco, and Target, all coming, I understand, this week. Why is that your focus this week?
Well, we got a bit of a disappointing number in terms of retail sales last month. And so we want to just see if that's something that was just seasonal because of a short buying season between Thanksgiving and Christmas, or if there's something more durable in that data that we need to be aware of. The earnings and the guidance coming from these huge retailers is going to be a key answer to that question. Are they softening their future outlook over the next couple of quarters because they feel like there's some type of weakness in the consumer, either from a wage perspective or just simply demand? Or was it just simply that short season between Thanksgiving and Christmas that consolidated a lot of buying in December, where we had a really big retail sales number, and it was just kind of a seasonal adjustment? We want to make sure that the earnings underneath these companies are still looking strong the way that we projected over the course of this year and into the first part of next year.
And to what degree would you expect maybe a different tone of results, a different tone of guidance from the individual companies? These four retailers can be grouped into, I guess, three groups. Walmart and Target are general retailers, general discount retailers. Home Depot, of course, is a home renovation specialist. Costco is a discount warehouse-style grocer and also general retailer. So they appeal to different sets of consumers. Would you expect a bifurcated set of results and guidance outlooks?
Well, it would be a signal if there were a big divergence between those groups. One of the reasons we like to look at these as kind of a group together is it does represent those different areas, those different sectors of the economy, and how consumers are interacting inside the economy as a whole. So if we saw a big divergence from one side to the other in terms of kind of the grocery aspect of Walmart versus just the general discount retailer at Costco, it would give us an idea that there might be something developing that we need to be more aware of and acutely impacting future earnings. So we expect probably pretty good results from Walmart and Home Depot, and we're a little bit more cautious on Target and Costco. Margins being the biggest concern for those discount retailers. Are they still able to drive out organic growth, or are they struggling under the higher cost of inputs that we're seeing, like eggs, as you were just discussing?
You mentioned the weaker than expected retail sales number of earlier this week, but absent setting that number aside, the most recent evidence has been that the U.S. consumer is in pretty good shape, is it not?
Yeah, it is. Absolutely. We've got a pretty strong labor market. Wages actually are increasing. And generally speaking, we're seeing a pretty strong trend in the overall retail sales data. So if I look at what happened in January, looking at a number of $625 billion, if I go back to October before the holiday season, we were at 623. So the numbers on a straight line look pretty good. And we just want to see affirmation from that coming out of the guidance in these earnings releases later this week.
Okay, let's talk about the broader markets. Markets are up so far this year, despite all the political headlines and perhaps headwinds. The S&P 500 up about 4.25% this early new year so far. What's your take on broad markets, and what do you expect for the full year of 2025?
Yeah, markets are up because we're seeing, results so far as we're about 3/4 of the way through the earnings season this quarter, and still roughly 77-78% of those S&P 500 companies are beating expectations, both in terms of earnings per share and top line revenues. And that's why we're seeing the market react positively at this point in time. I think it's important to note that we're seeing a broadening of the market. It's not just technology names that are driving this performance at this moment in time. We're seeing more sectors participate in this rally, and that's generally a good sign as we're starting to see, I think, investors maybe take some profits out of those Magnificent Seven stocks and look for, better valuations in the market, where we are still seeing positive earnings growth at this point in time.
Do you expect that broadening of the market to continue through the year? And if so, how should investors be positioned?
Well, at this moment, we know that rates aren't likely to move very much over the course of the next couple of quarters in particular. So we're still in a restrictive rate environment. And what we know is that higher rates make the value of future earnings go down. And so what you want to look for are higher quality balance sheets, those companies that have less debt on hand and the interest rate won't bother them as much in terms of a drag on driving out that organic growth. So there are companies in each of the sectors that are available to us that have those types of characteristics. And we're focused on some of those higher quality names. It might be not quite as attractive or as fun as the technology sector has been over the last couple of years, but at this moment in time, given the volatility that we've experienced, maybe boring is best at this moment.
Does that include small cap stocks, that broadening out? Do you see small caps benefiting, the Russell 2000 stocks?
Not on the same wide scale, if you will. We have seen some bump in small and mid-cap stocks, but again, keying in on those higher quality characteristics. We know that smaller balance sheets need to finance their growth, and the cost of capital right now is being a little bit restrictive on the ability to grow revenue over, that parabolic shape you're typically seeing from small and mid-cap stocks. So you have to be really, really picky about what types of companies you're getting involved with at this point in time. We know that with the threat of tariffs and things of that nature, small and mid-cap manufacturing might be a bright spot where you have kind of a cyclically value-based sector that starts to grow much faster. So it might not, again, just be technology that shines in 2025.
Brian Mulberry, thanks for this conversation. He's client portfolio manager at Zacks Investment